Hello, everybody. Now we are streaming from Silicon Valley, and today we have a very important guest from Silicon Valley to speak about should you really raise from in Silicon Valley. And before we start, before I introduce the guest, I'm really excited that we have such an incredible audience who are learning such difficult things and building companies. And those who are first time on our audience, we are going to give you a few updates of who we are and why this community exists. And while we're waiting for the rest of the audience, please start preparing your questions. We really appreciate that you guys like this stream, repost, comment, and definitely participate in the conversation. So our speaker will be able to give you the answer that that may help your business to grow. Now, we are a global community of entrepreneurs. This community exists just because we believe entrepreneurship should spread around the world, and we would like to give you as much tools and entire ecosystem so you can build your international companies. If you would like to become a member, very simple, just go on our website. If you have any questions, suggestions, or you want to join our team, just find our email and send us a message. So why do we exist and why we do such talks? The mission of the community that is very simple. We unite English-speaking entrepreneurs from around the world that really want to change the world, making it a better place. And we believe that everyone should have equal access to global capital, opportunity to raise capital, and most importantly, knowledge and expertise how to start international companies. And because of that, we bring speakers like Ben today, so they can give you the latest advice, information, expertise, and answer your questions that may help your business grow. But it's not all. We have some expectations from you, and if you joined our community and you became a member, you have the responsibility to help other members of the community. It's a culture of Silicon Valley, and we are building digital Silicon Valley for global founders. It's an ecosystem that unites global ecosystems in one place. We don't believe borders exist, and you are people from around the world actually making it happen so we can help each other on a global scale. This is our global team. We have people in the United States, Canada, Africa, Australia, Europe, Eastern Europe, India, Israel, and many other countries. So we basically have over 40 people in 30 countries. And these are entrepreneurs that are willing to help you to enter their countries and help you go global. We do have an automatic networking tool. This is a Telegram bot. If you register there, you can absolutely free get automated recommendations to connect with any of the members of our global community. So this is how you can expand your global network. And so far it was working amazingly, and people have the best positive reviews about that. This is for fun, our stickers created by our team, so you just may use it to enjoy and express your emotions through our branded stickers. This is just a gift for our global community. And the other very important thing I want to mention, we have people that really coming here to help you with expertise, knowledge. And we already had Bob Dorf, Ilya Stribulaev, Bill Reichert, Steve Hoffman, and many more. We had about 100 webinars so far with global speakers from around the world to give you tools, empower you with building international companies. So this is an important thing. These people are coming to help, and so we expect you guys participate and learn, because this is a unique opportunity for you. And I think this is what makes us a global community, because we can reach many people from different places, so they have an opportunity to meet you as well. Um, uh, in the end of this talk, I will also give you some information about our upcoming global speakers. But shortly, right now, this is our global partners. It's a short list. We have a full list on our website, but you can see that we have partners in Australia, Asia, Eastern Europe, United States, and on and on. So far, that's it. That's I wanted to tell you. This is our contacts. You can find us on social media. Find us on YouTube as well, Go Global World, and on Facebook, Telegram, LinkedIn. It's also Go Global World. But if you want to connect with our global audience, find open chats, Go Global World chat, and this is where you can introduce yourself and find connections in different places of the world. And basically, you can ask for help and help others. And you can join our database of startups that we might introduce to selected investors. It's on our website, and just become a member, register, sign up, and we'll take it from there. That's it for now. And now I'm really excited to introduce you Ben Narasin. Ben is a Silicon Valley venture capital investor and a very experienced person in venture capital. He manages his own fund, I personally got interested and inspired by Ben when I saw his how active he is on social media, and he has a branded vision on branded picture of himself that is so awesome that I want to talk with this guy. And when I spoke with Ben, he actually gave me so many interesting hints and advice. And one thing I really got into my mind, that anyone can pitch to Ben. He has a specific tool for that is called Pitch to Ben, and I'm sure Ben will give you some more insights about that. So Ben, welcome to our global community, and we are very excited to have you. Please tell us about yourself, and let's get into the topic.
Thank you. Yeah, actually, I'll start with the site you mentioned. I run a site which is www.pitch-ben.com to allow anybody in the world to pitch me a 1-minute video pitch of their business, and I promise them a 1-minute video response. It's often advice or ways to think about how to do a better pitch or a deck, but sometimes it creates follow-ons. In fact, yesterday, I agreed to my very first investment from a company that I originally met through the Pitch-Ben website. So one of the reasons I rolled that out is actually highly relevant to your audience. When I speak, I do a lot. I try to do a lot of public speaking to get in front of entrepreneurs, both because I want to hear their ideas and because I want to share value back. And I'll talk about my history and where my views come from in a minute. But one of the most common questions I get is, how can I access tier one Silicon Valley venture capitalists? I want to pitch them my idea. And when you ask that to most folks, the most common answer is always the same. You need to find a connection. You're much better off going through somebody that can introduce you. And that is true. But I always felt that was unfair. I mean, great ideas can come from anywhere. Entrepreneurs can come from anywhere. They can look like anything. So I launched pitch-ben.com as a way for people to make sure they could always get a point of view. Now, you may or may not agree with my point of view, but I'll tell you my history, and then you can figure out why you're hearing what you're hearing if you do pitch me or just from listening to this conversation. I was an entrepreneur for 25 years. My whole life has been about entrepreneurship. I started my first company when I was 12. I was a comic book dealer. I would go from Comic-Con to Comic-Con. Interestingly, my youngest son is now getting interested in comic book collecting. So, full circle. I started businesses all through high school and college. And in 1993, I started one of the first commercial web businesses in the world. I was not able to raise venture capital for that business, actually, and I did end up taking it public. And the only reason it survived, and the only reason that I was still the CEO, and the only reason we had a great outcome was because I never raised professional venture capital. So I took that company public in 99. I took it private in 2001 and then moved west. I ended up in Silicon Valley about 18 years ago, and I saw this significant gap between angel and venture investing. Angel on the one extreme is sort of slow and very small. And venture, which in the 90s was sort of single digit hundreds of millions of dollars per fund, had turned into a multi-billion dollar business per fund. And this forced the VCs to write bigger checks because you don't really grow a venture firm by hiring more people. That's very hard to do. You do it, but it takes a long time. It's a real Sisyphean process to get a job in venture. Anyway, in the middle was this gap, smart people with great ideas that needed a relatively modest amount of money to prove themselves. Because, as we all know, the cost of starting a business has plummeted over the last 20 years. Technology has made it so inexpensive. And so I was recruited in and ended up building and running one of the very first institutional seed practices in the world at a venture tech shop called TriplePoint. And over the course of about 8 years, I funded 80 companies. I had 1 year where I had two $5 billion outcomes, an IPO and a private round. And from there, I was able to move on and become a VC. One of the reasons for this, by the way, and this is important to understanding sort of where a lot of my views come from, because if you understand where somebody learned something, you understand what they might be trying to teach. When I joined TriplePoint, they asked me how many VCs I knew, and I added it up on a piece of paper, and the answer was 12. When I left that firm, the answer was 327. I spent a very significant amount of time and money actively getting to know tier one VCs. I was only focused on the top 10 firms, and I got to know those 327 people. And that's how I learned a lot about what I understand around venture. I was a freelance journalist, and so I treated every breakfast or lunch or meeting or shooting or golf or whatever as an interview. I want to understand what made these people tick, what they were looking for, what they did well, what they did poorly. And I got to sort of understand what made a great VC and what made a not so good VC. But also, more importantly, I got to understand what those VCs were looking for in businesses. So when I seeded a company, I needed to believe that that company was more likely than not to be able to raise Series A venture capital from a tier one firm that I knew if and when they proved their thesis. And I helped every single one of my successful Series A entrepreneurs with their raises. I would make introductions. I would help them with the term sheets. For those of you that know the Hitchhiker's Guide to the Galaxy, I am like the Babelfish of venture capital. You tell me what they said, and I can tell you what it really means. So I've spent a lot of time with a lot of entrepreneurs. I've funded 110 entrepreneurs over the last 14 years, and I've learned quite a bit. After being a seed investor, I went on to be a traditional Series A investor at Canvas, the Go Forward group out of Morgan Thaler, where I was a general partner. And then I went to NEA, where I was a full-time investor, and I did Series C investing, even ABC. So I've seen the whole spectrum. I've helped entrepreneurs raise a lot of A's, a few B's, and even a C or two. And so when I talk about the realities that I think about around venture, the topic we're covering today is really, should you raise Silicon Valley venture capital? Is it appropriate? Because it's a global game, right? Like I spent a lot of time in Europe over the last couple of years because there's a growing amount of really exciting opportunities. Now, we can talk about this through Q&A, but I will tell you the number one thing that I tell entrepreneurs, just because VCs have money doesn't mean it's the right flavor of money for you. If you're going to raise venture capital, you need to really understand what you're getting in for. I've created what I call the Ben rule. I was always envious of Moore's law because, Moore had his own law. And this is basically a quick sort of shorthand for you to think about whether you should raise venture capital. First, think about what you believe your most promising and ultimate outcome could be that would be adequate for you. What is that thing you're going to drive towards? What's that thing that you call success? Okay. You're going to have to put a number on it. What's the outcome? What do you get bought for? What's the company worth when you get liquidity? Get that number in your head. Okay. Now divide by 5. $50,000, $50 million, $500 million. For every $5, you got 1. So multiply by 20%. Now, if that number is not at least half of the size of the current fund of the venture fund you're targeting, you shouldn't be targeting them. And this is a key learning. It was for me early on because I never had venture money. You got a $100 million fund. Well, let's use $1 billion fund because there's a lot more of those. You're typically going to own 20% of the company that you invest in, hence the divide by 5. All right. Now, at liquidity, let's say you have a goal of being $100 million outcome. $100 million, 20% goes to the venture firm. That's $20 million. But it's $1 billion fund. VCs don't make any real money, not carry anyway, until they've paid back the entire fund. So your $100 million is only $20 million to them. And that means they have $980 million to go before they make carry. It's not an investment they should be making. And it's not an investment you should be taking from them, because in some cases, it happens less now than it used to. Those VCs will keep you from taking that exit. I think good firms are generally supportive of their entrepreneurs in most cases, but there's some great firms that have some of the best outcomes ever that do not support their entrepreneurs on these small exits, because their job is to return the fund. So you need to be material to the fund, and I'm defining material as at least half the fund. So if you've got a $500 million fund you're pitching, right, then you need to be able to figure out why you're going to be able to sort of get to about a $250 million outcome for them, which is a $1.25 billion exit. And if that's not what you're looking to achieve in your life, if that's not what you need, forget about what you want. Everybody wants lots of things. If that's not what you need, then you shouldn't be raising venture capital. And I've learned this through people I like and through people that really were jerks, but it's true. Venture was not funded to fund good companies or very good companies or great companies. It was funded to invest in the future phenomenal companies, the future public companies. And those are a tiny sliver of the businesses that are created each year. You can count up how many businesses are created each year, which are globally, tens of thousands. And you can count up how many IPOs happen, and those are in the, hundreds or tens, depending on the year. So, don't take money from the people that are not aligned with you. Take money from the people that are. My last comment on this, and we should certainly, we can drill in whatever level you want, is think of it this way. Lions only eat meat. If you're trying to feed them a salad, they're going to eat you. So, don't feed a salad to a VC, because maybe you're the one that ends up on the plate.
Yeah, it's that's a good point. You can end up on their plate. But in terms of Silicon Valley, what are the typical profile of founders local venture capital investors are looking for, and what are the typical mistakes startup founders are doing, in your opinion?
It's interesting. I think a lot of folks talk about diversity and access. And what I've learned is that people, for the most part, this community is a meritocracy. If you're crushing it, nobody cares what you look like or where you came from. But they like to see the proof in the pudding. When I first moved here, I thought, everybody's seen the classic hockey stick that people want to see in their, investments up and to the right. I used to think that VCs were looking to invest here just before that happened. But the reality is they want to invest here after it started to happen. VCs are traditionally a fuel on the fire investor class. There are instances where they'll go earlier. Seed is one, and some braver Series A firms. But generally speaking, they want to know you figured out a business and you now need money to scale it. I'll give you an example. I funded a company yesterday. They went from $0 to $6 million in revenue in basically a year. And they did it with no outside investment. That's very exciting. I won't talk about the company specifics because, proprietary, but net $0 to $6 million in revenue in a year with no outside investment. Wow. Imagine what they could do with some money, right? So that's a perfect example of a company people get excited about. One of the last deals I was involved in before I left to start my own fund, and we should talk a little bit about what my fund is focused on, because that'll also teach you a little bit about Silicon Valley investing at a different level. It was a Series A that went from 0 to 2.2 million in about a year, and they got paid a very healthy price. In the old days, I used to tell entrepreneurs if they get from 0 to $1 million of ARR in a year, they would probably be able to raise a Series A. I don't think that's true anymore. I think you need to get to $2 to $3 million of ARR to really get people's attention, because you're not competing with other people that are doing what you're doing. You're competing with every single person that came in and pitched that business. And when 4 people pitch 0 to 1, and then somebody else can pitch 0 to 6, the 0 to 6 person is going to get all the attention. So, I think one of the common mistakes, and I made it myself, is believing that the investor is going to fund your general idea. That is super rare. I mean, as a seed investor, yes, sometimes I fund concepts and PowerPoint slides pre-product, but for a Series A investor, a traditional silicon, they want to see performance. They want to see what's actually working. The dog's eating the dog food. When I think about investing and venture capital and this entire ecosystem, there's really two parts of your journey. If I'm going to massively oversimplify it, there's the journey I tend to fund, which is 0 to 1. You have an idea, you might have very early proof, but you need to prove a thesis to show that this is something that can grow. And then when you get to 1, which is also called product market fit, it's about repeatability. It's rinse and repeat. One of the biggest mistakes I see entrepreneurs make, because entrepreneurs tend to be very bright people, and they're constantly thinking, I know how this is. I did this myself. They get from 0 to 1. They find product market fit. People are paying them for their product. And then they try to figure out something else to do. And I'm always trying to help people understand, no. Your job, once you find product market fit, is to rinse and repeat. You will be very bored with your product, but that's okay, because there's like almost 8 billion people on the planet that don't know your product exists yet. So keep selling that product. Build a sales team, build a sales org, rinse and repeat, rinse and repeat, rinse and repeat, grow. If you want to understand what venture looks for, look at what the public markets look for, right? Because every VC worth their salt wants to believe their company can be a public company. I do not know any investors that I really think of as tier 1 top performers that don't invest with an eye to how they can have an IPO. If they're investing because you can have an IPO, awesome. If they're investing because they think you might get bought as some tuck-in investment, I don't think they've learned their job yet. Or it's just a tier 2 group, right? They're willing to take smaller outcomes. Smaller outcomes can be great for smaller funds. It's just, I think it's a weakness. How you do anything is how you do everything. Focus on the best, focus on the biggest opportunities. And by the way, we'll all be wrong most of the time, but you've got to shoot for big targets. So, it is critical that you get your product to the point where you've proven that people want it and will pay for it. And then it's critical that you focus all your energy on growing those sales. You look at the public markets, as I mentioned, what do they care about? Growth and margin. They don't care if you're profitable. You're growing 120% a year with 75% gross margins. People love that. And by the way, look at recent IPOs. Those numbers are happening on companies that are in excess of 100 million in revenue, right? It's not about, I grew my business $1 million to 2 million. That's a great start. But generally, sales slow over time in terms of percentage growth. And you see companies going public that are, still seeing just amazing growth, even at bigger numbers. So growth and margin are sort of the two most critical things I think you have to focus on in your business. Now, the nice thing about that is that's a very simple thing to say, and there's an unlimited number of things that you're going to have to work on to get those two things to happen. But it all foots out. In fact, if you want an easy rule of thumb, does it help margin or does it help growth? Because if it doesn't, you probably shouldn't be doing it.
Yeah. Well, I understand growth margin and repeatability and basically, but most of the startups that are looking at Silicon Valley, they ask, like, what is the reason of those companies who went public, why they are valued so high? And you just explained in a simple way, but maybe you can give a little bit of more details, like why those companies having very low revenue, they're worth billions of dollars. What would you say on that?
Well, I mean, if I had a perfect answer, I probably would be sitting in my basement trading stock options all day. But, like I remember I talked to Goldman Sachs right after they took a company public quite successfully that had relatively low revenue, but huge valuation, multiple billions. And I said, what was the thesis in the institutional buyers that stepped in? And they said, look, they look at this as an option buy on an enormous industry. You have to think about how big can it be over time. One of the things that's true about venture capital, and it's also true for IPOs, is you tend to be overpaying for the current value of the business, because that's the only way you can get the shares. The entrepreneurs aren't going to sell to you for less. You've got to think about how long will it be before your price is rational and then it gets bigger. Think about Amazon, right? They lost money for a tremendous amount of time, but they were buying market share. I met Jeff in the early 90s, and it was pretty clear he wasn't just interested in your bookstore sales. He was interested in share of wallet. And that's certainly what he's gotten. So, if you have a business that has the opportunity to fundamentally change the world in some way, let's pick a business I haven't seen much in. Let's say that you had a business that could fundamentally change oil drilling. I don't know. Seems unlikely. Well, oil is an enormous industry, no matter how much pressure there is to move towards alternatives. So if you can get oil out of the ground for $10 a barrel instead of 30, the market size for you is virtually unlimited, right? And so maybe you don't have much revenue yet. Maybe you've only got one well. Maybe you're only throwing off $1 million worth of oil. But the fact that you've proven you can do it and that it could scale is what people will give you the money to do. They are buying tomorrow, and they will pay a lot for tomorrow. You will always overpay for the most exciting businesses, but then you'll everybody will overpay pretty much forever. Also, there are businesses that, are look at the value of data right now. And so when you see sort of a transformative shift where all of a sudden every major company needs to figure out what to do with and how to leverage their internal data, then companies that focus on data lakes and data optimization and AI and ML all of a sudden become extremely valuable because, it's like the day before the car became a product, people that made carburetors, nobody cared about. But if you were investing in the first carburetor company, I bet you did really, really well because guess what? As the day one, what did they sell? Enough to get Ford to make some cars. Day two, still not that interesting. Day 500 gets pretty exciting. So people are paying forward for what the future opportunity can look like and how big the opportunity can be. Nobody cares if you're profitable because that probably means you're limiting your growth, right? If you can reinvest that money and still make margin on the incremental customer, let's say it cost me $30 to get a new customer, but I make $300 on them in the first year. Wow, that's great. So if I have $3 million worth of profit, am I right to put it in the bank? No. I should put all of it into buying more $30 customers. They're going to make me 300 million. And then when I have 300, when I have all that extra money, I just keep recycling it, right? Like as long as you don't have to be profitable, you do have to have a path to profitability. There are countless businesses, Amazon included back in the day, where if they'd chosen to throttle growth, they could have been profitable. But who would throttle growth when you have the entire market to take over? So people are buying the future. It is sometimes a little fickle, certainly, but how big is the opportunity? Has it been displaced? I'll give you an example. I looked at a company I was pretty excited about. I couldn't get there in the end for one reason, but it was in the chemicals space. Chemicals industry is enormous, and it hasn't been disrupted by technology in a material way. So I thought, wow, almost unlimited size. That's what I want. I want uncapped upside. The reason I didn't make that investment was I didn't believe, after all my diligence, that the industry was ready to adopt the technology. Now, in the building space, the construction space, I did an enormous amount of research, and it looks like the industry is ready to convert. And so I was willing to make investments there. So sometimes, look, you are going to be too early as an entrepreneur. The key is if you're too early, you're bankrupt. But if you're too early, you'll be at the right place at the right time when things finally take off. And then if the ultimate market you can get because of it is uncapped, that's what people get excited about. Uncapped upside is the catnip of venture capital.
Great. I like the way you put it because it's this is the exact explanation I would like to know from a VC because people are really struggle to understand that, and I think you put it really well. And now I'm sure the audience will have a clear understanding on that. But we have a question from outside the United States. First of all, mobile app monetization is saying that they will do a pitch to you. So the guys got interested about pitch to Ben. There is one question. Maybe this person is not really into startups yet, but he's asking your opinion. Will VC be interested to invest in a small business in India? I guess not, but since
the very fact that he used the word small.
Yeah.
Look, all big companies start off as small companies, but I'll go back to my point. What's the size of the opportunity? I have only one investment personally in India. I made the investment because somebody that I know and trust got wildly excited and because they were able to show me that the opportunity was staggeringly huge. It was basically, it's the wholesale delivery of food to all the merchants that sell, whether it's rice or flour or whatever else. And I met the entrepreneurs and I was very impressed with them. Here's one thing I always say about my own approach to investing. Everybody's a little bit different, but I need 5 things to make an investment. People, 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 a great idea, and a huge market that works. The people have to be awesome, smart, tenacious, driven, focused, but the idea has to be one I believe in, and the market has to be huge if it works out. So, the farther you are away from a VC, the harder it is to get their capital, because they have to think about the fact that they don't have a network on the ground, harder for them to do due diligence, harder for them to help you later, harder for them to help you hire, all kinds of things. VCs generally want to add value beyond just the money. Now, different areas have gotten different levels of attention. India's gotten a reasonable amount of attention over time. Different people have done well there, others have not. Europe's getting a lot of attention right now, as I mentioned. Pre-pandemic, I was spending a lot of time in Europe and the UK looking for opportunities. Here's an interesting way to think about this. VCs tend to gravitate towards areas where they know there can be really big outcomes. So the reason VCs now care a lot about Europe over the last 4 or 5 years is that 2 years ago, there was about $30 billion worth of exits in the Nordics, right? You see things like the Supercell King battle, where you got several multi-billion-dollar companies. You see things like Klarna. You see these companies that exit at these big, big, big numbers, and all of a sudden VCs pay attention. Same thing happened in the US. I grew my business in New York City, but after the bubble, people didn't care about New York City and venture. And then one day, a couple of companies started to get really exciting and really big. And guess what? All of a sudden, the VCs cared again. A friend of mine said VCs are like penguins on the ice floe. They waddle over the edge and they look in the water. And they know there are fish in there, but there might be walruses or seals that'll eat them. But then one day, a penguin slips into the water, gets a fish, and then all the other penguins pile in. And that's the way it is. Once there's something big and exciting in a region, people run to get there. I think it varies. It also varies very much by firm. Some firms like to spin up operations in local country. Other firms like to try and do it remotely, where they send people to spend time on the ground, but they're still based in the US. So, it's not about you're big or small, or you're in India or you're in Afghanistan. It's about, do you have a massive opportunity ahead of you? And if it's a big enough opportunity, I think bluntly, nobody cares where you are. But you've, of course, got to find a way to get to them. There are, I do so many, I used to host visiting countries and visiting MBA programs and have them into the firm, and I would let them all pitch and I give them all feedback. Switzerland has a startup team, and oh man, I have Germany and the UK, and I'll be in the UK next week, and then I'll be in Seoul, Korea. You're always looking. You're always trying to find that exciting opportunity. But what VCs don't invest in is what they would call a lifestyle business. So, if you're going to build a profitable company that's going to make, 1 to 10 million in revenue and throw off, $100,000 to $3 million a year, that's not a VC business. It's a great business for you, though, right? This is one thing I want people to understand. There is absolutely nothing wrong. I remember once I was talking to an entrepreneur, I was like, well, why wouldn't you just own this whole business? It's like, it's going to cash flow like crazy. He's like, what? I'm going to run some lifestyle business? I was like, you've got a business that at 10 million in revenue could probably make you $1 million a year. Why is that bad? Now, he had bigger dreams, and that's fine. It takes bigger dreams to get to bigger outcomes, but just be careful about how you fund things. You've got to fund things with people, as I was saying earlier, that match your needs. And there's lots of logical businesses that make a lot of sense, but don't make any sense for venture. Can you be a future public company? Realistically, if everything goes right and you work incredibly hard and you get lucky? I'm not saying you be a public company if you're hit by lightning level of things. I'm saying your plan works, you get lucky, you get some of those right clients, things progress and things go exactly as you dreamed. Is that a public company? Because if it's not, don't bother to pitch venture. It's not a fit. Not a fit for you to have their money. It's not a fit for them to have your investment, in my opinion. And in the opinion of most people, I consider the best investors in the world. By the way, sometimes there's tricks to get to the people that don't get that yet, and they're weaker people in terms of how they invest. In my view, I know that might come off as arrogant. And, sometimes entrepreneurs that have absolutely no business raising venture capital get venture capital, usually from younger partners that haven't figured out their job yet, that don't really understand that M&A outcomes are not a target you should be shooting for. And a lot of times those companies, well, I've seen people make investments I thought were clearly not venture scale, and I do not remember a single time when it has worked out for either party.
Yeah, I have I have a person on the team. They have a startup. They recently raised $4.2 million. It's a fintech startup, and so and the interesting thing, they were not going after investment for quite a long time. They were raising non-venture money, like from different grants, from different I don't know, some government sources from around the world, where they were doing some giving some money for specific purpose. And it's impressive that VC money is not the only source
Yeah,
that
exactly.
you can get.
Non-dilutive capital grants. I mean, that's awesome. You get a grant where you don't have to pay it back and you don't have to give up any equity. Wow, that's
Exactly.
great. I mean, you need to be jealous of your equity. You need to make sure you keep it tight.
Yeah, and I found some good amount of founders at early stage that they don't really understand the value of their equity, and that's very sad sometimes, because they give it away so freely, so easily. And I don't know, it's even more in as a countries outside the United States. I met some founders that don't understand why they should give some equity to their early teams to motivate them, and they don't really understand. What is
Yeah.
your opinion on giving equity early team, and how it can motivate their team to work?
Yeah, when you ask like what are some of the most common mistakes, I think one of the common mistakes, it's not that common, but it's when an entrepreneur is too piggish with their equity. When you do a Series A round, there is always what is termed an option pool. This is the percentage of the company that you set aside to grant to your employees as you hire team members. Now, in the US, if you're one of the first 10 people, they usually call you a co-founder, which I find humorous. But net, in the old days, that used to be 15% of the company. Sometimes entrepreneurs fight that. It does dilute them. But I always have said to entrepreneurs, if you want to build a world-class company, that's like the minimum. Because I'll give you an example. Remember, I talked about a company that went from 0 to 6 million in revenue in a year with no outside investment. I'm making an investment there. And we're talking about how to use that money. And my approach would be, I'm a giver of advice. I'm not a teller of what to do. And I said, I think your best use for this money is to hire more salespeople. But don't just hire salespeople. Hire a chief revenue officer. Hire a head of sales. Now, I was talking to an entrepreneur yesterday. He's been looking for a chief revenue officer for 6 months. He's already spent $200,000 in recruiting fees. He doesn't have anybody. That person is probably going to cost him $250,000. And I'm going to guess 0.5% to 1% of his company when you're early. The earlier you are, the more of your company you have to give up, because the risk is far greater. And if you're going to recruit world-class people, they're going to be taking a pay cut to work for you, because you can't go to a big dog at a big company and pay them what they're getting paid before. That 240 is going to buy somebody that's probably making 600 somewhere else. But you're going to make up for it by giving them option upside. You've got to share the wealth on the equity. If you don't, you're not going to build a strong enough team, and that's a weakness for you. And that's going to be a huge concern for me. So 10 to 15% of the company is not uncommon right at the beginning. Actually, 20% of the company is not uncommon right at the beginning, so that you can build a team. If you're thinking you can just build this yourself and give people just a payroll, well, here's what you're going to get: second-class citizens. A's hire A's, B's hire C's. Hire better than you. Hire better than you in everything you do. As soon as you start worrying somebody's better than you and they can replace you, it's the moment you get weak. And by the way, if you have a board and they notice that, that's when they start thinking about the fact that maybe they do need to find somebody else. When they see you hiring people that are stronger than you, when they see you hiring people that could replace you if anything went wrong, they feel confident in you. They don't have to worry about it, right? So the only way you're going to get those people, this is the most challenging recruiting environment that I have ever seen, or that anybody I've worked with in the recruiting space has ever seen. It is crazy right now. So, you're going to have material options to provide. Now, you can compete in other ways. As an example, as big companies make their people come back to work, if you can say someone can be remote and keep living wherever they're living, that probably helps. But net, like when it comes to cash and equity, a friend of mine joined a really hot startup recently, and he called me for advice. He wanted to know about their VCs. He wanted to know what I thought about the company. And then he called me about his compensation package. And he was taking a major pay cut. And he said, but I think I can get it up to here. And I was like, you're focusing on the wrong things. Don't focus on your cash comp. Focus on your options. Get more options. You didn't leave the job you left to make half the money so that you could instead negotiate for 60%. You left because you could have world-changing money if things went well. He called me the other day to thank me because that company went public for a few $1 billion. So everything he got in extra options was material valuable to him. But you know what? He was a top dog in his industry. He's exactly the kind of people that that company needs. And that's exactly what gets them to be a public company. Think about, begin with the end in mind. I took a company public without an adequately built out team. It was hard. And I was lucky because it was the world of the web, right? And people are so excited. I know luck matters. It will matter to me. I work exceptionally hard. The harder you work, the luckier you get, but you still need luck to find its way to you. Luck is the combination of hard work and opportunity meeting each other and a little bit of serendipity thrown in. So if you're going to have a public company in the future, which is sort of where I focus on types of companies I want, you think you can go public with a bunch of employees? No, you're going to go public with a strong C-suite, a CFO that's taken companies public before, a sales operation that's run by somebody that's scaled sales teams, a VP engineering that's built a robust site or product or app that can really weather the growth from 1 million to 10 million to 100 million, right? If you don't have that, you're not getting out. The market is harsh. They see weakness in your team. That's not gonna work. And by the way, this isn't happening with a really strong team. If you're the best Formula One racer in the world, you still need a very efficient pit crew. So you're going to have to carve out a lot of equity. The more you can carve out, the better. It's a team that's going to win. It's funny. I play Call of Duty Zombies, and it's always frustrating when somebody comes on and they're only playing for themselves. The best video game competitors, they're teams. It's all about the team.
Do you play using headsets, or is just a normal?
I do, but not all the time because not everybody does. I'm not that serious. I'm a casual player, and I'm okay. I get to level 30, but not get to level 50. So I'm not like Easter egg obsessed like everybody else is. But it's just frustrating for me when sort of people are greedily just trying to get the most points and aren't opening doors and don't revive people. It's like, guys, there's 4 of us. 4 of us get a lot further when we play together than when you go off on your own and try to be a pig. Why don't you play solo instead? So, but it's one of my favorite phrases I ever heard in venture was A's hire A's, B's hire C's. The best people want to hire the best people. And as soon as you let weakness into your team, you're making a mistake. It's a very common thing I end up talking to entrepreneurs about a lot when they have it's something that people learn is when they have that first critical person that they hired, they thought, and now they have to fire them. You have those conversations all the time. But I'll tell you this, nobody wishes they'd waited longer to fire somebody. You always realize you should have done it sooner.
That's actually something that might be a great word of wisdom. I already heard this phrase, but that's kind of very concise learning for founders who are now starting building their companies. But can this apply to selecting VCs, in your opinion?
Oh, no, you can't fire VCs. So the reason I try to tell people you got to be so careful is taking money from venture capitalists is a marriage. It's a 7 to 10 year journey. And you enter into that marriage with a one-way prenup that you do not control. Your board has really one primary responsibility: to hire and fire the CEO and to make sure that, there's succession planning. So you can be fired, but you cannot fire your VC. They're on your board. They have the right to be. It's just, so you got to be really careful. You got to make sure you're with somebody you can stick it out with for a long, long time, that you believe will have the best interest of your company at heart and that will help you grow. All right. So it's a non-reversible decision.
Is there any advice on how to spot the wrong relationship with the VC? I mean, you probably have a lot of hints on how to find the wrong founders, so the ones that you don't want to invest. But what would you advise on selecting the right VC so the relationship?
Yeah. Why don't I answer this? And we've got 15 minutes left, so then we can sort of flip. I see a bunch of questions from the audience. Let's go to those next. But
Yeah.
this is important. Now, look, it boils down to diligence. You've just got to do as much work as you can. One, spend as much time as you can with that person that you're considering taking an investment from, as they should be doing with you, and do calls. Like ask them for references, certainly. But here's a trick. Ask them for references. Great, call those. Ask all those references for references to other people they know that this person invested in. Now, that's not the trick. That's just sort of common sense. Look at the person that's considering investing in you's materials, whether it's their website or their page on their firm or their LinkedIn, and make a list of all the companies that they've listed being involved in. And then start Googling and make a list there and call all the companies that they invested in that are not on their list. Find out how this person acted when things didn't go well, because that's when you find out the true colors. But it's diligence. There's no excuse to just not do the work. If you just take the highest term sheet, it's on you, man. I mean, I've had some really interesting outcomes where they could have been a lot bigger, but somebody had to take the highest term sheet, but the highest term sheet didn't come from the best person. By the way, no surprise if you think about it. Why is it the highest term sheet? Because they're not going to win against the best person, right?
Yeah.
So be careful. It's hard for an entrepreneur to say, I want to take the lower price term sheet. But if the person is a big enough spread, it's sometimes the whole difference between success and failure. Not always. Look, I'm not saying VCs always add massive amounts of value, but sometimes the difference can be critical. And sometimes it's not even about adding value. It's about not getting in your way. It's about not messing with you. There are people out there that'll mess with you. It's not fun. I had a board like that. Not fun. That's why I'm so obsessive about who my entrepreneurs take money from, because I had such a bad experience.
Yeah.
All right. Why don't we do questions in the last 15 minutes or 12 minutes that we got?
Yeah, sure. So SV is asking, can we fundraise being outside the United States, having sales, I guess, in the United States?
Yeah, I mean, as I said, the farther you are, the harder it is. But VCs fund companies all over the world. There's been a lot of new businesses popping up in Africa, particularly fintech companies. Europe's been getting a lot of traction. Different parts of Asia, China being a little harder right now. But it doesn't matter where you are. It matters that you have a phenomenal opportunity.
An explorer is asking, at the pre-seed stage, what metrics would you expect? What evidence of traction?
It varies a lot. These days, a lot of folks that are going out to raise seed have already built their product, have already launched. And so you can get early information. You can get early traction. You can get early sales. You can get margin. Other times they don't have that yet. Maybe they have a prototype. Generally speaking, I would like to see real numbers. I'd like to see everything from cost of acquisition, engagement, margin. There was a company that pitched me recently. It's an intriguing business. And they have built a marketplace, and I've done a lot of marketplace investing. Now, before they launched, maybe I would have considered just investing purely on idea if I thought the idea was big enough. In this case, though, it's sort of niche-y, and so I was a little worried. They launched, they only had 24 hours of data. And I said, look, I'm willing to go pretty early, but I would want to talk to you again in 1 week and in 1 month. And that will show me at least a trend line, a day, a week, and a month, because their numbers were good, but there were 1 day's worth of numbers. So a day, a week, and a month seemed like a lot better. And the size of opportunity seemed big enough, but the entrepreneur was educating me, and I just needed a little more data. So, that's probably the easiest place. It's always easiest when there's some traction to judge from. Sometimes it's concept and need. If something doesn't exist and it's desperately needed and you found a way to deliver it, and I can find out that you actually can deliver it. Or here's another example. I was sitting down with this one company that I just invested in. We went through their whole process. I said, show me the first outbound email you did to get the account. Great. Show me the SOW. Show me the PO. Show me the campaign. Show me the individual contents in the campaign. Show me the results of the campaign. Show me when they paid you. Show me the aging, right? Like, I just want to understand, just like I said, you should spend as much time as you can with the VCs. I want to spend as much time as I can with the entrepreneurs, because I worry a lot about whether the entrepreneur will make it. Not just because of their business. Being an entrepreneur is an incredibly difficult job. I believe it is the hardest job in the world if you are not a first responder. If you're putting your life at risk, that's a different thing. But if you have a job that takes place in an office using a computer, there is no harder job than being an entrepreneur. Every day you wake up, you're responsible for your entire team. If you screw up, they're out of jobs. Your clients don't come through when you think they will. They don't live up to their promises. They take longer. You're basically getting hit in the face with a virtual sledgehammer all the time. So it's hard, and it gets harder. And if you're willing to quit, you're not going to make it. So I worry about that a lot. I want to understand why my entrepreneurs are going to push through difficult times to get to the other side.
How a VC can help us grow? What would
every VC pitches how they can help you grow, and some actually do something about it. I will tell you, it's different for VCs. So I'll tell you me versus a VC. So a traditional VC might have a team to help a bit with hiring, a design partner to help with design. They might even have a internal biz dev arm. I will tell you what I do. I try to be available to my entrepreneurs for anything they need. I've gone to conferences and pitched on behalf of an entrepreneur, and I won the competition, by the way. It was a global competition, got them a lot of press. I've helped them land board members. I have helped them land clients. I'm constantly looking. Whenever I run into somebody that I think could be a customer for my entrepreneurs, I ask if I can introduce them. I think business development, hiring, board recruiting are all important. And a lot of it also, when I talk to my entrepreneurs, it's I was an entrepreneur for 25 years. I started a company based on a sketch on the back of a napkin in a bar, and I took it public. I've seen the entire journey. I can help you not make the mistakes I made. Right? I can help you with advice that, you're not going to have a lot of people to ask. Who are you going to call for that really hard, gut-wrenching decision you're making? You're going to ask your team? By the way, I'm talking about decisions that scare the crap out of you, right? You're going to go to your team and admit you're scared and you wonder if you should do this thing. And maybe if you do it and it's wrong, it kills your whole business. Investors, I was an operator and an investor. An operator for 25 years as an entrepreneur and an investor for 13. I've made the mistakes, I've lived the life, but I've also lived vicariously alongside of many others and watched how it's worked for them. So it is both my time as an entrepreneur and my time as an investor that I can bring to bear for all the things that I've learned. But, I go back to, everybody says they're going to help. Do the diligence. Each individual is different. Some people will fully admit they're basically stock pickers. They make the investment and they show up for the board meetings and that's about it. And others are more proactive. I once said to my entrepreneurs, I want you to keep one of my founders I'm on the board of. I was like, why don't you create a scorecard where every board meeting we talk about which of your board members did more for you, specifically referred you more clients, referred you more leads. And I wanted to do that for two reasons. One, I knew I would win because I had a lot of people on the board and everybody else had none. And two, I wanted to pressure the other board members to come on, let's go, do some more. I want more clients for you through me, but I want more clients for you for everybody. So it varies tremendously by person, and you're going to have to figure that out. And that's part of what the diligence is. You're going to ask entrepreneurs, what has this person done to help? They say they're going to help. What have they done?
Another question from startup. How to select the right advisors? Should we do it? Does it bring value?
It's a crapshoot. It's really unknown. I mean, look, net, if you get access to the right people, it doesn't matter what you call them. It's great to have access to them. I'll give you an example. So I've started this new seed fund. I focused on everything before the Series A. It's called Tenacity Venture Capital. And one of my LPs is Jeff Immelt. He's the ex-CEO of GE. And part of what he's doing with me is he's offering me hours to give my entrepreneurs for office hours.
Wow.
I mean, that is phenomenal. This is a guy who once I was talking about one of my entrepreneurs going to Germany. He said, well, I'm good friends with Angela Merkel if that would be of any help. I mean, the guy's got a phenomenal network. So, you get somebody like a Jeff Immelt as an advisor, and he will be on my board of advisors. So I'm super excited. I believe I will get huge value out of him. But again, go back to the diligence. What's their network like? What are they actually going to do? Having an advisor for an advisor's sake. Look, I don't take advisor roles. I have on rare occasion in the past, but now that I'm doing a fund, it makes no sense. But, I'm Mr. Access to venture capital. I'm Mr. Tell them what they mean. So, a person in that sort of setting could be very valuable to you. Getting an advisor that can get you access and help you understand how to navigate this community, if this is the community you're going to end up raising money from, could be great. But it's like saying, I'm going to eat some food. Is that good for me? Well, I don't know. Are you eating dirt Are you eating a bag of sugar, or are you eating, healthy vegetables? The answer is very different. So think about what the person can do, and you should be able to determine whether that's valuable. You have lots of experience that you haven't gotten yet. So if you can get it from people that have already gotten it, there's I love pithy little sayings. One of them are aphorisms. It was, good judgment comes from experience, but experience comes from bad judgment. So why not find somebody else that's already got the experience from the bad judgment and help, let them help you. All right.
There is a question from a startup from Russia, I guess, and that's a little funny question. Why are US VCs scared of Russian founders? Is there anything?
Well, I mean, look, some of the best founders in the world are Russian, right? Google's Russian founders. I'm half Russian, by the way. My entire engineering team was Russian. I think that it is fair to say, I even went and spoke at the opening of Sokobo, the sort of Silicon Valley of Moscow. I would definitely say people are a little scared of Russia. I mean, the relationship between Russia and the US is not good. Look, I was in the apparel business a long, long, long time ago, and I was going to make shirts in the Czech Republic. And I was all excited because I could get flannel from Russia for $1 a yard, and flannel from Portugal was $3 a yard. I was all excited until I talked to the head of the plant in the Czech Republic. He said, Ben, it's $1 a yard when it leaves the plant. It'll be $3 a yard when it gets here. And I was like, why? And he was like, you got to pay everybody off along the way. The way of doing business in Russia, at least perceived, is very different than the transparent methodology that the US is accustomed to. And you just can't be in a position where you don't know the real answer. But I have seen a bunch, and I've funded a handful of Russian founders. They've been here in the United States. I was intrigued by some of the founders I met in Russia when I was there. In fact, on pitch-ben.com just the other day, I had a pitch from a Russian founder, and I followed up. I want to learn more. But yeah, also like, where is the company? Like, this guy's a Cyprus entity. Here's the other thing. If it's plain vanilla and everybody understands it, it's easier. But as soon as you say to me, well, we're a Cyprus entity, then I'm like, I don't know what that means to me. I have to now go ask my lawyers. What's my downside with a Cyprus entity? How do I protect myself? Do I have to protect myself? Does it matter? Do I have to have them spin up a Delaware corp? But, if you think about places that have at least a reputation for some challenges in terms of the way business is done, Russia's up there. And I think that would be the bigger issue, because we know that the teams can be brilliant. There's a story that all these millisecond traders that have to get like a couple of milliseconds ahead of a brokerage firm trade that make billions and billions of dollars, all their teams are Russian, because the Russian teams tend to be more efficient in their code. And efficient code means faster code, and faster code matters when you're fighting for a millisecond. So now, I don't think people are afraid of Russian founders. I think they're afraid of Russia as a country, as a legal body, as a business practice, and et cetera.
Yeah,
well, by that, as I said, I'm happy.
Living in the States for quite a while, I met lots of local US people who were supporting me in my entrepreneurship and wherever I was doing. But also I met some people who were an interesting solution, but we are unlikely to work with you, and we don't want to say why. And later on, you find out that's because you're Russian. Like, what's going on in here? Like, well, I have not.
Yeah, it's like I think it's hard to understand how people that are jerks operate if you yourself are not a jerk. But, I could care less what you look like, where you came from, where you went to school. I care that you're brilliant, driven, focused, tenacious, and have a great idea and a huge business ahead of you. And, if they truly weren't willing to fund Russians, then they truly would have missed out on funding Google. And Google and Facebook are the two biggest outcomes I think that have ever happened in ventures. So they would have missed it. Yeah. But we're up on time. I've got something else coming up. I really appreciate you having me on. As I said earlier, if you've got an idea that you want me to listen to, it's www.pitch-ben.com. I'm not fast at responding, but I promise that everybody will get a response. And I usually tweet when all the responses are complete, so they're there. And you get alerted when I do respond. But I will promise feedback. I won't promise a follow-up, but sometimes follow-ups happen.
Do you want to take one last question about your fund, because people are really curious, and there is
Sure,
one.
sure. Okay. Yeah, why not? I have to promote myself.
Yeah. So please tell us about your fund, the check size, criteria, and how to
Yep.
apply.
Yeah, normally you're not allowed to talk about this stuff, but I did an interview with the Wall Street Journal, so now I'm what's called a 506c. So that brings up a couple things. So my fund is a $50 million seed fund focused on everything before the Series A. I got commitments for over half of it in the first 25 days of raising, which was pretty interesting. I'm told that's top 1% performance because, it usually takes a year. Yesterday was officially my first close. I've learned that people don't always make the date. So there's a little bit of straggling, but, about half the fund. And I have actually two ways people can get into the fund. There's the main fund. The main fund is that $1 million minimum, traditional LPs, they come in the normal way. But I believe there's a lot of value to be accrued from having a wider network. So I've created what I call an affiliate fund, which AngelList is administering for me. And so if you're on AngelList, you could probably find it. It's called Tenacity Venture Capital. And my name is Ben Narasin, Narasin. You can also hit me up on LinkedIn. I actually read everything that comes to me through the messages over LinkedIn. And that fund, the affiliate fund, was created to allow people that either founders, investors, or strategic value adds, or my friends, to put in smaller checks because I want as broad a network as possible. They get the same treatment as the regular fund for the most part. The two differences are, one, the main fund has capital calls where your money is deployed over, say, roughly a 3-year period. The affiliate fund, you have to put the money in when you close. And AngelList charges a small fee on top. So feel free to hit me up on LinkedIn or look for me on AngelList if you're interested in learning more. Send me a note. Tell me what your sort of appetite would be for size, and I can direct you in the right way. And I've got lots of materials, and we can find a way to connect. And keep an eye out for Tenacity. Take
Thank you.
care.
Thank you so much. And what is your final words of wisdom for our global community of entrepreneurs? And this is Ben Narasin, who we were speaking about how should you raise in Silicon Valley or not.
Yeah. If you really want to raise in Silicon Valley, you better be thinking big. And I do think there's a difference between what you want and what you need. Everybody has something in them they need to achieve. I'm looking for entrepreneurs that are looking to achieve something enormous. I have no lack of respect for entrepreneurs that are trying to achieve something else. By the way, think about this. You get a business, you run it for 3 to, let's say, 5 years, and you sell it for $100 million. And you own half of it, $50 million. That's life-changing, right? Good for you, but it's not a fit for venture. When I ran my company, I had to have a public company. There was something I needed. I turned down an opportunity to sell that company for more than I made post-IPO because I so had to have that. Now, look, you could argue that was irrational, arrogant, however you want to think about it. But, choose your path and then fund against your path and be transparent about it. A lot of people inflate what they think their business can be. I think that's a huge mistake because those people that invest in you invested in the inflation. And then when you get to your real true desire, they might get in your way. You might not get to take that outcome. I know plenty of people that had the chance to take an amazing outcome for them that didn't work for somebody else, and they didn't get to take it. How'd you like to be 3 years from now and have an offer of $100 million for your company and you still own 50%? And the answer is no, because venture term sheets usually come with veto rights. Doesn't happen as much as it used to, but it could. Don't take that risk. And always do the diligence. Find the good people, find the helpful people, do the work. There's no excuse for being lazy, whether it's in the diligence or the work you're doing. This is a long, hard job. When you're thinking about maybe taking a little break, maybe easing back, remind yourself that's not how you're going to get there. You just keep pushing, right? So keep it.
And that was Ben Narasin from Silicon Valley, general partner of Tenacity Venture Capital. Thank you so much, Ben. That was a very, very important conversation for us and very helpful, very interesting. We appreciate that, and definitely our audience will be using the service to pitch you. And we already have some requests to connect with you. So thank you for your time.
Thank you. Take care.
Take care. Goodbye. Thank you so much.